Good morning, and thank you all for joining us again. I'm Colby Durnin, the CEO of CREDE, and today I have the honor of hosting Greg Econn, who's a dear friend of mine who I hate to admit how long we've known each other or both been veterans in this business. We're taking a little change today and approaching real estate from an insurance perspective. Greg is the CEO and third generation leader of Venbrook, which is a national insurance company. His background ranges from working directly for his insurance to getting a master's at Cambridge and working at Lloyd's and being the president of a New York listed stock exchange insurance company. So, Greg, thank you for joining today.
Pleasure to be on with you, Colby. Thanks for the introduction. One thing is that it was in conjunction with Cambridge University at Lloyd's of London, so it wasn't specifically Cambridge University.
Well, that is definitely speaks of you as you, because I've never known you to hype anything, and especially when it comes to insurance coverages or costs. But maybe talk to us a little bit about Venbrook. Running a firm that's a multi-generational firm. You guys are on your fourth generation now. That in itself is a feat.
Oh, thanks, Colby. Yes, my grandfather started the business in 1919. My dad took over in the 40s. I took over in the 80s. And my son, who's joined us just within the last year and a half, is now representing the fourth generation. So we are in our 106th year of the retail insurance brokerage business. Venbrook has morphed from a relatively small firm into a national powerhouse. When I joined, we had 49 employees. Today, we have over 700 employees. It's been a wonderful run, and frankly, we've learned a great deal throughout that entire process with respect to not only the carriers and the interest that insurance companies have in trying to do the right thing, and I'll explain what I'm talking about a little later on. But not only that, and trying to do the right thing, but also trying to find a happy medium with respect to the pricing of the product that they're willing to offer. There's two things that are involved there, not only with the pricing itself, but also the risk and the rewards from proper underwriting. And we'll talk about that as we get more into this conversation.
Oh, great. I was going to say, yeah, I'd love to dive into that more, but, maybe let's go back for a second. There's lots of different avenues of how to get into, I'm going through this with my daughter right now of how to pick a profession. And, I could have been a physician. You could have been a lot of things, but why real estate? What created the passion for real estate that ended up taking you from, I've got a little inside baseball here, not just development, but got you from real estate into insurance itself?
Great question. In 1978, I bought my first apartment building. It was a 6-unit building. And I quickly learned the benefits of real estate insurance and real estate as it related in particular to taxation. So at that point in time, you could actually take ordinary income and reduce your ordinary income on a dollar for dollar basis based on the depreciation. If you took an accelerated depreciation compound, even better. So bottom line was that I started understanding it from a different perspective. The firm had been a well-known firm, James Econn and Company, for real estate insurance developers, et cetera. We really had 4 core practices, one of which the main one was in not only the insurance for developers, but also insurance for property owners and managers. So over time, I started working almost exclusively with those particular industries, Colby. And one of the interesting things that I found was that I could actually underwrite better, in my opinion, than an underwriter could. And that makes a lot of sense because we're the guys that are on the firing line. We're the ones that are out there talking to the insureds, looking at their past, their present, and talking about the future, and looking at the portfolio makeup. So an insurance underwriter who's sitting behind the desk somewhere else in the United States is trying to make decisions based on the information that we present to them. So as long as you present the appropriate, honest picture to the insurer, and the insurer understands that you understand the risk, and we'll talk about that in a little while as far as the REAPA program, then they are far greater, you have a far greater probability of a successful transaction with the insurance carrier, other than just submitting an application and hoping it gets somewhere in the line and they look at the application, maybe they'll respond back with a bunch of questions. Take a very proactive approach when it comes to underwriting, and in particular, if, as I specifically have done, specializing in the real estate insurance world, I know who the players are. They know who I am, and it makes life a lot easier.
You know, you mentioned 1978 and accelerated depreciation. So we're luckily back in accelerated depreciation with the Big Beautiful Act. But naive question, what are we able to do now? Is there anything different that we should look at for 2026 based on the new tax laws and accelerated depreciation with insurance that we couldn't? You hit me cold with that one, and I'm asking you a naive question that I don't know the answer to.
Frankly, I don't either. I don't know what it's like today, because my real estate holdings are very different today than they were 40 years ago. And so it's primarily residential and homes for all intents and purposes. So from a depreciation perspective, absolutely, the Big Beautiful Bill, if it's giving us a greater opportunity to look to the past as far as taking depreciation and offsetting ordinary income, fantastic for everybody that's going to be on this podcast.
Okay. You've always been a passionate person, and I mean I remember the first years you and I met, you were just flying back to London to work with Lloyd's to set stuff up. But maybe talk about, how do you you've always had a ton of passion around real estate. So like, how do you approach it, and how do you approach it for a client that makes Venbrook different or your team?
Great question. So I'll start with, as a matter of course, the vast majority of business that I do all comes to me by referral. So I've got a distinct advantage right off the bat, because whomever it is that referred me has told them about what we do and why we are a different brokerage firm. So with that in mind, recognizing that 90% of my business is all real estate and all manner of real estate, from habitation, basically apartments, all the way to industrial and commercial. A few office buildings today, and we don't really have to get into the situation with office buildings, they are exceedingly inexpensive to insure and simple to insure. So that leaves that one. That doesn't do anything for me. I can't add value. That just becomes a price transaction. But the value that I bring to the table is not only pricing, but it's coverage and service. So we really sell three things, Colby: coverage, service, and price. And number one is coverage. And let me explain a little bit about that. So to answer your question more specifically, I recognized years and years ago that I knew more than, frankly, just about any underwriter I did business with. And those that knew more than me, I learned from. And over the course of the years, having taught, I was an adjunct professor for real estate insurance at UCLA for 30 years, despite the fact that I'm a staunch Trojan, but I would wear my cardinal and gold in there. In any event,
you're talking to a guy that's from a split household, so I understand.
So, by the way, the boys, my two boys were the most recent graduates, and they were numbers 28 and 29 in the family to go to USC. So we've got a pretty good lineage there. So what I did was I said, look, since I have this substantial book of real estate business, and it's all over the place, I wanted to consolidate. So what I did is I went to London, because having studied over there with Lloyd's and Cambridge, I knew a lot of the underwriters, which was a terrific opportunity for me to get in front of them with this book of business, recognizing they realized they know who I am, they knew my integrity, they knew that if I brought them something and I told them it was X, they knew it was X. And the credibility factor when you're dealing with underwriters, no matter whether they're domestic or international, credibility is critical. You have to have a track record. You have to have performed properly and always honestly. So when you do that, you tell the not the good with the bad, you tell the bad with the good. Start with the bad, because that's what's going to derail the process. If it's something you say, hey, Greg, we really can't do that. We don't have, railroad protective coverage in our policies, and I know you've got a railroad exposure. I said, perfect. Let's move on to the next deal. So it makes it, and they really appreciate that, because they've got 8 hours. They're being bombarded daily with opportunities. But when the opportunity comes from someone they know and respect, and they see the business and they write a lot of business for you, the advantage that I have is tremendous. And as a result, I felt that over the years, Colby, that the best way for me to, if you will, impart value to my clients is to have a much better handle than a typical retail insurance broker. So I formed a company. I formed it's not, I wouldn't call it a company. I formed a risk purchasing group for property, and it's complicated.
Is that REAPA?
Yes, exactly. REAPA stands for Real Estate America Property Association. I started it 15 years ago. Our total insurable values are far in excess of $10 billion. And I am the underwriter. The insurance companies, for all intents and purposes, have handed me the pen because they believe in me. They know that I'm not going to screw them. I'm not going to put a risk in there that I wouldn't personally underwrite. So with that kind of credibility going into the marketplace, I really don't have to go to the marketplace anymore. For real estate property insurance, I have the best program in the business. The form itself is induplicable. I'll give you one particular feature that is astounding to most. We insure the loss of market value, not just replacement value, but market value. And I'll give you an example. Let's say you've got a building that has an FAR of X, and it was built at Y. The delta between the two is called the market value. Okay. So if I can put it back at X, in other words, I'll put back a building, I'll use units. I had a 100-unit building. I could only put back 75 today based on FAR, parking, all sorts of different rules and regulations. And so now I put back a 70-unit brand new building whose market value, inarguably, for the 75 units would be more valuable than the 100-unit building that we lost. Obviously. So 75 units to 75 units, my new 75 units are worth more than the old ones, obviously. The delta between the market value immediately preceding the loss, and let's say that was $10 million, and subsequent to the loss, it's at $12 million. I put up that new $10 million building, and I give you a check for $2 million. And we've done that on numerous occasions in the past. Underwriters, they balk at it, and because of the buying power and experience, it's worked out well. Question.
So Greg, we were just talking about insuring for market rate risk. So, maybe you could explain a little bit what that means. Like, as an example, had I owned a multifamily building or a commercial building in the LA or Maui fires, and I can't build back, what I previously had, is that, in simplistic terms, you're saying that would have actually been covered?
Yes. So from a commercial perspective, not on the personal lines, not on the homes, but on the commercial aspect, let's take a 50-unit apartment building that burned down in the Palisades. Now, today, you can only put back, based on the various and sundry limitations, FAR being a perfect example, density, etc. You can only put back 30 units. Now, these 30 units are brand new, inarguably worth more than 30 units of the old building. But the old building had 50 units, and you now only have 30 units. And let's say that the market value immediately preceding the loss was $50 million, and after the loss, it is $40 million, because you've got you've got 30 units, but they're brand spanking new. So the delta between the current market value and the original market value, 10 million in this example, we give you a check for $10 million, in addition to putting back your brand spanking new building with all code upgrades, etc. So that's the loss of market value. It's a huge, huge advantage for those of us that are in the real estate business, and in my case, obviously the insurance business.
And I'm sure it varies all over, but is there a cost per 100,000 or a cost per million that we should budget for that?
No, you're right. It varies obviously based on the insurability of the asset, hard insurability. In other words, was it built prior to 1990? Is it sprinklered? Is it fire resistive? Is it, frame? Have there been prior losses? What's the roof like? There are all sorts of underwriting factors that we will look into, of course, that will make a difference based on, from a pricing perspective, that 30 units original, or the original 50 unit building, what I'm talking about. All of those went into the pot to make the determination that they would qualify for REAPA. So I make the determination as far as qualifications. I establish the deductibles. I've already established the the coverages. It's a 56-page form, which is exceedingly to the advantage of the insured. And they're moving quickly into what's happened, obviously, on January the 7th. We lost a home ourselves, and thankfully that particular house was in my program. Even though I insured the house for X, it's going to be 2X to repair that house. It doesn't matter because you're in a blanket program. So when you have these big blanket programs such as REAPA, and there are other programs that are out there that are good, but they're not as good as mine, simply for two reasons. One is nobody can touch the coverage, and number two is I'm the underwriter. If I like it, I have to go through the steps, but I think maybe they turn down 1 in 50, 1 in 30, 40, 50 that I present. So they know that, because they look at my loss history. My loss history over the last 15 years has been profitable to the insurance carriers every single year. Why? How do I do that? They don't have anything else that's anywhere near that, because I'm the underwriter. I make the decisions, and I'm a tough underwriter. In order to qualify to get into REAPA, I'm not going to take a bunch of old buildings in downtown LA that are, the inhabitants are suing left and right for habitability related issues and the like. And we talked about that briefly, Colby, before we started, about from a habitability perspective, property insurance still really very effective today. In fact, you have broader coverages available in the standard marketplace, and the rates are down by about 10% today. That's the good news. The bad news on the liability side is the rates are up by about 10 to 15%. That also includes the excess umbrellas, where there's been a real contraction of limits that are available. For example, we used to go to Chubb and say, I need a $25 million umbrella. And within 10 minutes, I had a quote for a $25 million umbrella. Then it dropped down to 15, then to 10, then to 5, and now it's 2.5 part of 5 excess of primary. That's how crazy the market has become, just using them as one example. So it's habitability from a liability perspective in the state of California, which has caused enormous problems for the insurance carriers and therefore for our insureds. The only way we can really get viable coverage today, if anybody's had any losses whatsoever from a habitability perspective, is a very large liability deductible starting at $25,000 and moving on up.
Well, you just started to hit on my question. Any advice for our listeners of how to alter their buying or, deductibles, or is there a different way to approach insurability at this point?
From a property perspective, no. When you're buying a building, in the old days, you'd buy a building and you didn't care what the prior loss history was for the prior owner. Today, no insurance company will write a new building that you acquire without the prior 5 years of loss run. So that's why when you go on and buy a piece of property, or anybody else buys a piece of property, you always ask them for the 5 years of prior loss history, because you know that the underwriters are going to require that from a property perspective. That's also on the liability side, but the liability, as I mentioned, is much more difficult today. There are fewer markets. The coverages are being whittled down. Habitability is usually excluded today, and we have to now sometimes go out and buy it independently. The bottom line is that as a property owner, you got to do the best you possibly can to keep your tenants happy as it relates in particular to mold and rat infestation and mice and termites and roaches, everything. So you can't imagine the amount of claims that we see that are frankly frivolous. I had a spider bite where the insurance carrier paid out $220,000 for habitability. They call that a loss of habitability, a spider bite. So they're looking for ways to get out of this too, frankly. And if I'm an underwriter, now one of the little sector, which is auto, which is still really tough. You would think that it wouldn't be, given the fact that we've got all these self-driving capability cars out there today, and that's a subject for another complete discussion. But so liability and auto liability in particular, both are really tough to cover today. And all you have to do is look at a billboard. Anywhere you go today, injured, call Jacob, call Sweet James, call this, call that, blah, blah, blah. So the social impact on insurance from a liability perspective has been negative because of all these attorneys that are advertising, call us this, it's in Spanish, it's in Greek, it's in Portuguese, it's in, French, and Italian. So the bottom line is that the insurance buying public has greater access to legal representation than they ever had before. And the frivolity of the vast majority of these suits is such that they're dismissed from a nuisance perspective, and the insurance carriers are just paying out $5 or $10 or $15 or $20,000 or $25,000 just to get rid of these things, because they know full well that the liability and the defense costs alone are going to. And frankly, you go to court. Here's something, and I'll leave you with this one thought. The vast majority of our listeners today have been requested to appear to be on for a jury, right? Well, the people that are actually going to be on that jury are not the people that are probably in this audience. It's other folks that really don't have a job, they don't have anything else to do, so they get on a jury. And so they're looking at things that are from a far different perspective than you or I are looking at things. And as a result of that, these jury verdicts today are getting to be just absurd, and the insurance carriers, unfortunately, are the unwilling participants in having to compensate.
Well, that's a whole different social aspect to get into, but many of us that are listening have captives, or we have our own insurance. How would you compare, say me having a captive versus working with you with your REAPA program? Is it a similar concept or different for buying power, or how do you, is there a comparison there?
Yeah, good question. It's similar in certain aspects. So one in particular is, in a captive, you are basically taking the first X of risk. In REAPA, you take the first X of risk. So the way REAPA was set up is very similar to a captive, but you don't see it. I'll give you an example. You pay in $1,000 premium. That premium is broken down into 3 different categories. Pure premium, in this case, I'll say is $750. That goes to the insurance companies. 150 more goes to what's called the Plus Ag, which is an aggregate fund exclusively there to pay losses, a deductible fund, if you will. There are no commissions, no fees, taxes, overhead, anything taken out of that money. That is dollar for dollar that goes into that pot. It is the first line of defense other than the actual policy deductible. Then the Plus Ag pays the losses. Year before last and last year, we had 0 losses to the insurance companies. Very, very unusual when you've got, closing between 13 and 15 billion of insurable value, 68% of which are frame stucco apartments. So, and then the other one, the last component is Cardigan, which is the managing general agent that puts the whole thing together, that we own that. So that's how $1,000 gets distributed, if you will. Well, the same thing kind of happens with a captive. That Plus Ag is where you are as the captive owner. Then you buy excess coverage above X, whatever number that you're comfortable up to. So say you want to take the first $1 million, so you buy 9X of one or however, and then you start layering up. So as time progresses, your captive becomes more and more robust as it relates to hopefully not having any losses. So that gets larger and larger. Same thing happens with the way we set up REAPA, although it will never get that large because there will always be losses based on the number of clients that are in there. I make the decision who goes into the program. It's that simple. And I look at your loss history. I look at another thing that I do is I check the reputation. I know enough people in your business that I can find out from somebody what they might know about this person. In fact, I have my people even go online and go to the various websites for their various buildings and look at what the tenants are saying. And the carriers know I do these kinds of things. They know I have reputational checks. Nobody else does this. So if I bring a risk to my REAPA underwriters, it's a fait accompli. It's just a question of how am I going to price it.
So Greg, that's really interesting. And I like the comparison with REAPA versus a captive. But I mean, aside from potentially joining REAPA, as we look towards 2026, is there anything else that we should change? I mean, the last 5 years, it's basically been just increase your insurance, increase your cost, increase everything. It feels like we have a slightly softer market right now because we haven't been building as much. But can you maybe give us a little 2026 forecast and what your thoughts should be for clients?
Sure. Thanks, Colby. For sure. Let's talk about habitational, because the other industries, industrial, commercial, etc., those have really been pretty steady even over the last 5 years. They're not too tough to insure. It's habitational. It's apartment buildings. Apartment buildings have been seeing 3 to 5 to 7% minimum increases over the past 3 to 5 years. And I say minimum. If there have been losses, then it's like, two things happen. Premium goes up and deductible goes up. But more importantly, if you can mitigate your losses and take risk yourself, you're going to benefit from it in the long run. That's number one. Number two is to answer your question about where do I see in 2026. Absolutely, property premiums are coming down by anywhere from a minimum of 8% to as much as 20%, depending upon how it was previously priced, but a minimum of 8%. In fact, if you put in 10% in your pro forma, you'll be fine. Your broker, I'm sure, can handle that. So that's it on the property side. The liability side, I would take it up by 10%, but the liability premiums are substantially lower than the property premiums are. Well, if the past is any indicator of the future, but we're seeing some pretty crazy things, as I mentioned earlier, as it relates in particular to habitational. One last plug. If anybody has friends or has directly lost anything in the Malibu fire, the Palisades fire, Altadena fire, go online to Steadfast LA and you'll find a lot of very, very useful, very helpful information that will help to ease the issues that you're going through, because I've been contacted by literally probably about 1,000 people, hundreds and hundreds, and met with hundreds of homeowners and so forth, because I chair the insurance division. And helping 10,000 people for me has been the greatest honor of my career, to be honest with you. And fighting these insurance carriers and coming up with solutions as it relates to the future and the affordability and availability of homeowners insurance is my goal, and I will achieve it. That's it.
Well, thank you for that again. So just to repeat that, where should people go for, if they've lost a home in the fires, and then also where can they either find you or one of your representatives from Venbrook if they want to learn more about either REAPA or just general underwriting?
Number one, and most importantly, as far as anybody that's lost a home or have been impacted by the fires, go to Steadfast LA. I think you'll find information in Steadfast that is going to be very, very helpful to you from a wide variety of resources. Number two is, if somebody would like to get in touch with me, please feel free to do so. I can be easily reached at Geconn, that's Geconn, at Venbrook.com. Venbrook.com.
Well, thank you, my friend. Always great to see you, and always very good for your insight. It's what you and I do isn't always the sexiest part of real estate, but it's amazing how we can influence costs and investment outcomes.
Absolutely. You know what? We make it fun. I love beating the underwriters. That's my goal. beating the underwriters. So, because when I beat the underwriters, I beat my competition, and you guys are the ones that benefit from.
Well, we'll talk soon, and thank you again for your time today.
My pleasure, pal. Take care now. Bye-bye.
Take care. Bye-bye.